All right, this is Sarah Cage, and I'm joined by my co-host Adam Olson, and today we welcome Robby Sundberg, a senior manager, and Caroline Willet, a manager here at Embark, to discuss CECL. Both Robby and Caroline have done a deep dive into CECL and taught several trainings over the topic. Welcome, guys.
Hello. Thank you.
Thanks.
Before we dive in, I'd like to introduce a fun little segment that I like to call That Sounds Like, where we talk about the accounting acronyms and what they sound like before we talk about what they're actually referring to. So I've got a few, and if you guys have any, just jump in. All right, CECL. Sounds like your mom's great uncle Cecil, who lives up in Boston and talks about how good the Celtics were when Larry Bird was on the team. Or Cecil, the name of your nephew's turtle that keeps dying, but his mom keeps replacing it because she doesn't have the heart to tell him that his turtle's dead. Cecil the turtle.
Sounds personal, Sarah.
No, those are really just made up.
The one that I had was that it sounds like the hotel in the new Netflix docuseries that's a little bit creepy.
Yes, unless you have a British accent, in which it's called Cecil.
That's right.
Hey, you could call this CECL. The acronym still works. So, all right, well, now that we know what CECL isn't, Caroline, can you tell us a little bit about what CECL actually is?
Yeah. It's an acronym for current expected credit losses. And it's actually not the name of the standard itself, but it really just refers to the valuation model introduced in ASC 326. So it's a new model to estimate credit losses on financial instruments. And CECL model really just aims to more accurately reflect the collectibility of financial instruments like loans receivables, trade receivables over the entire life of the asset. So it's a pretty significant project and has some pretty wide-ranging effects. So that's why we're talking about it.
Okay, and why did we need a revised standard?
During the financial crisis, it became pretty clear that the timing of loss recognition and management's expectations of collectability they were inconsistent with each other. So under the incurred loss model, it had to be probable that the loss had already been incurred, regardless of future conditions or expectations. And so investors were just getting, information too late to make any kind of decisions or timely decisions on, financial statements. So CECL model is really intended to better align timing and management's expectations of collectibility, and just to give financial statement users more decision useful information. So, yeah.
Awesome. So I know, just jumping in here real quickly, that the CECL standard came out in 2016 originally. So it's been out for a number of years, and companies have had been hearing about it. And obviously in 2020, this past year, it was required to be implemented for public companies. But when I'm thinking about our private companies who have yet to mostly adopt CECL, a lot of them are thinking CECL sounds like it's more financial industry focused, banks and lending industry, lending institutions, things like that. I don't really have to worry about that. So, from your experience, what would you say to companies like that? What do they need to keep in mind as it relates to CECL, even though they may not be in those types of industries or institutions?
Yeah, it's a good question, because I think a lot of the initial focus was on those large financial institutions with, more complex portfolios, more, different kinds of financial instruments. And so if you actually dig into the standard a little bit and you look at what's in scope, unless you operate, entirely in cash transactions, you probably have some financial assets that will need to be evaluated. So if you have trade receivables, you'll need to assess the allowance on those trade receivables using the CECL model going forward. So, loans, receivables, corporate bonds that, expect to be held to maturity, lease receivables on the lessor side for some sales type or direct financing type leases. I think, all are in scope and all are things that companies need to be really assessing, even if you're not, a large bank or a public issuer.
Yeah, no, I definitely agree with that. I think it's definitely something that private companies need to definitely keep in mind. Although the evaluation may not be as complex as what they see those in the financial services type industries are going through, it's definitely is still going to require some due diligence for sure. Maybe just switching gears here to Robby real quick. So, historically under GAAP prior to CECL, we had the incurred loss model, which everyone's pretty familiar with. Can you just maybe at a high level talk about maybe some differences or how under CECL guidance credit losses will now be recognized versus what people are used to?
Sure. So as you just mentioned, and Caroline mentioned as well, legacy GAAP applied what was commonly referred to as the incurred loss model. And essentially, this meant that losses were recorded when it was probable that a loss had already occurred, regardless of the likelihood that a loss would occur in the future. So it didn't take into account, losses that would take place in the future. The CECL guidance, on the other hand, does not contain any kind of a probability threshold like was included in using the incurred loss model, and requires recognition even if the risk of loss is remote. So that's a significant change in terms of recognition. Under the CECL guidance on day one, so upon either the acquisition of a financial asset or the origination of a financial asset, a company must estimate on that initial day expected credit losses and recognize an allowance for the expected loss at that point in time. So that's a key difference. Another key difference that is implied in what I described is that legacy GAAP only looked at the past in determining the loss to be recognized, but under the CECL guidance, the past, the present, and the future all must be considered. So that's a big change, not just looking at the historical loss experience, but also looking at current conditions and future forecasts. Reasonable and supportable forecast is the way that it's worded in ASC 326. So all of those different factors need to be considered under the CECL model. So those are the big differences from a model perspective.
So maybe just to summarize, so it's definitely earlier recognition of credit losses. As we kicked off, that was kind of the importance of why we needed the standard, was just the incurred loss model was too slow to react to potential losses. And so obviously that was impacting investors and things of that nature. And then it's really looking at that estimated loss over the expected life of the asset itself. So not just looking at it, but really looking over that contractual term period or forecast period that, for what the expected loss might be.
That's right.
So I guess maybe kind of building onto that a bit, how do companies actually come up with, what their credit loss is? Maybe let's focus on more of the non-banking industry, take out some of the complexity that obviously, the banking institutions obviously have more complex modeling and probably large teams helping work on this for a number of years. But maybe for your more run-of-the-mill products and services type industry company or something of that nature, what would they need to think through when they're trying to figure out, how do I apply CECL and how would I model my credit losses under this guidance?
Sure. So the first thing that I would say is that there's a lot of flexibility in terms of how they do that and the different options that they have. The CECL model doesn't prescribe a specific way that they have to do that. So the CECL model provides some principles, some high-level principles for the types of things that must be considered, but they don't prescribe a way that it has to be done. So for example, I mentioned in one of the previous questions that the estimate must incorporate the past, so your historical loss experience, as well as the current conditions, and then reasonable and supportable forecast of the future. So therefore, whatever model a company creates, they have to consider all of those things, right? So flexibility in terms of way that it's done, but those particular pieces need to be present. And so some of the models that you'll see specifically and especially with non-banking companies and that we've seen with our clients as well is that especially for non-banking clients, many of them will use an aging schedule-based approach or a vintage approach. And we see this a lot because it applies largely to trade receivables in terms of application. And it's a popular approach because it's very similar to the approach that companies took to trade receivables under legacy GAAP guidance. And so it's familiar. And so it's very similar to the way that they would have thought about calculating their allowance for doubtful accounts under legacy GAAP. And so that's a very popular approach because it's familiar. Many of the accounting processes are already set up to support it. And so using an aging schedule, just to kind of by way of kind of a little bit of an example here. So using an aging schedule, a company might have already compiled historical loss rates for its trade receivables. They put it into various aging buckets. So you have your current receivables, your 1 to 30 days past due, 31 to 60, and so on. And so to that point, to a company, your process is going to look very similar to what you've always done with allowance for doubtful accounts. But the difference here under CECL guidance is that you can continue to use this aging schedule-based approach, but using your historical approach, you would just look at historical data, right? Under legacy GAAP, that's what they would have done. But now a company, they'll continue to do that, but they need to layer onto that the expectation for the future, right? What do they expect? What's that forecast look like into the future? And layer that onto their aging schedule. And so that's the big change. And that's the model that I think we see most frequently, especially for companies where their primary exposure to the standard is with trade receivables, because many of them already had a similar type of process in place for their trade receivables. And so the simplest way to sort of transition to the new guidance is to layer on the additional requirements relative to the current conditions and the reasonable and supportable forecast of the future. So that's perhaps the most common form or model for non-financial institution type clients and companies. Certainly other models are available and being used. So loss rate, probability of default, discounted cash flow. Many non-banking clients will apply those as well, especially to the extent that they have financial assets that are in scope that kind of fall outside of trade receivables, different types of loans receivable or things like that, held to maturity, debt securities, those types of financial assets that they might hold in addition to trade receivables. They may apply a different model to those, just depending on what makes sense for their specific situation.
Yeah, no, that's helpful. I think, I guess in some of the examples that I've helped clients with over the last year and a half or so, when I think about their trade receivable analysis, for sure, they're starting with that historical aging incurred loss model because, in most cases, kind of your historical loss rate is your starting point. And then it's whether or not you need to adjust for anything based on current conditions. And a lot of times I know, especially on the trade receivable side, when the life of the trade receivable is pretty short, you got like a 30-day turn for your accounts receivable. When you think about adding on that layer of a forecast period, it's, the contractual term for that financial asset is pretty short. So I know a lot of companies are making the argument as well that there's not a material change for factoring in kind of a forecast period, but obviously 2020 was a bit of a nuanced year with COVID and things of that nature. So even shorter term, I know financial assets that were in scope for CECL also had to kind of take a deeper look at that to make sure that even in 30, 60, 90 days, especially as customers maybe were slower to pay, whether that forecast assumption needed to be adjusted as well. So that was definitely a good summary there and good points to kind of keep in mind, especially as people are kind of thinking through, where do I start? What do I need to do? Am I kind of completely starting from nothing here, or what can we leverage from our existing processes?
Right.
I guess maybe one more thing to touch on with the CECL model. I know, one of the other big changes here is that there's a requirement in the standard that you have to pool your financial assets.
Mm-hmm.
There's some flexibility for how one company may or may not pool assets versus another, in order to come up with a separate CECL estimate for each of those different pools. Can you talk a bit about just maybe how the pools work, maybe how a company would, determine what types of pools of financial assets they might segregate, and then, maybe any best practices or things that you've seen or heard for entities that are kind of going through this process for the first time?
Yeah. No, this is a good topic to discuss as well. So, unlike for legacy GAAP, the CECL model does require that assets with similar risk characteristics be pulled together and evaluated together. And so that's significant because, again, the requirement is that they have to do that. So this isn't just an option under the guidance, but it's actually required. So again, the standard says that assets with similar risk characteristics need to be pulled together, but it doesn't say, which is kind of a theme, right? It doesn't say exactly what risk characteristics should be considered. So there's flexibility here as well. It's something that, as you might expect, is going to be very company specific, and it's going to be even more so very financial asset specific. So the guidance does, however, provide, which I think is very helpful, some example risk characteristics. And there's actually quite a long list. If you go look in ASC 326, it actually provides quite a long list of different options in terms of risk characteristics, but it's not all inclusive, and it makes that very clear. There's a lot of flexibility there, but just some of the examples that it includes are things like credit scores, risk ratings, the type of financial asset, different types of collateral, the term of the financial asset, a variety of others, right? So there's a lot of different risk characteristics that can be considered, and really pooling of assets really requires kind of taking a step back, looking at what drives the risk of loss associated with each of those financial assets that you hold, and seeing where those kind of fit. So, and I guess an important point too is that you don't have to pick one. It's not like you say, oh, I have to pick credit score, and I have to kind of split all of my pools by credit score. It's really, you might have, pool A is current trade receivables with a retail customer in the U.S. And so there we've kind of taken three different sort of risk characteristics, and those three together make up our pool. Versus your second pool might be loans with a 5-year maturity and borrowers with excellent credit, for example. And so you have these different pools made up of different risk characteristics, but it's going to be very dependent upon the types of financial assets that a company has, the conditions that are in place at the company, in the industry, macroeconomically. There's a lot of things to consider. And so from a best practices perspective, it's important to remember that the risk pools may shift, right? Because what makes sense today from a risk characteristic perspective is likely to look different in 5 years or next year. And so making sure you have kind of good governance in place to evaluate your pools and the right stakeholders providing input into that discussion is really important, so that you can ensure that you're pooling your assets appropriately, putting assets together that should be together because they present the same kind of risk profile.
Yeah, I think there's definitely a lot of flexibility here as well, right? It's companies looking at which of these kind of risk characteristics are really their key drivers for how they evaluate risk as an entity. And so that's, where the focus is. And like you said, they're not, they're definitely a static concept. It's like a one and done assessment. So companies really need to make sure each reporting period they're evaluating those pools, looking at them, making sure that the existing pool still makes sense, or to the extent there's financial assets in a pool that don't fit. It's either revising the pools or I know the standard even potentially talks about that a particular financial asset may be its own pool on it, by itself. And so
That's right.
credit loss would be assessed on that individual asset. So definitely good reminder.
No, that's a great point. If it doesn't fit, it has to be evaluated on its own, which is perhaps what you might expect, but it's an important point because you don't have to just fit it into another pool just because it doesn't have a pool to fit into. Just evaluate it on its own if it doesn't fit into the others.
Awesome, thanks, Robby. To elaborate a little bit more, we talked about there's a lot of flexibility, a lot of variety in developing the model, the allowance, and we talked about not focusing only on the past, also looking at the present and the future. What are some other things companies should be thinking about as they're developing these estimates, like the term or potential recoveries? Is there anything else that should be top of mind?
Yeah, so let's talk. One of the examples that you mentioned there was contractual terms. So we can talk about that first. So, and this has been, I think, brought up by several of us kind of throughout this, but under the CECL guidance, a company is required to estimate losses over the entire contractual life of the financial asset. So as a result, as a general rule, the longer the contractual term, the larger your estimate of the current expected credit losses will be. And this is because as you go out into the future, there's so much additional uncertainty that exists. We kind of talked about this even in the case of like a trade receivable that's 30 days type of trade receivable. Well, that doesn't go out very far. There's not a lot of uncertainty 30 days out, relatively speaking. But if we're talking about a loan that has a 30-year term, well, I don't know what the world's going to look like in 30 years. There's a lot of uncertainty associated with something that goes out 30 years, especially relative to something that's 30 days. And so generally speaking, the longer the term, the larger that estimate of expected credit losses is going to be. From a loss recovery perspective, there was actually some, just kind of by way of a little context here. So there's actually some initial confusion in some of the initial ASUs related to the standard on this point. And the FASB clarified in 2019-04 that an entity should consider recoveries in its allowance for expected credit losses. So it's important because it means that that entity should consider expected credit losses within the allowance for expected credit losses and should not directly write up the related costs. It also means that because an entity recognizes recoveries as an adjustment to the allowance may have a negative balance in certain situations where there's been a write-off and a subsequent recovery. So really important kind of point here is that they should be considered in your estimate of expected credit losses.
Wow. I think that might be the understatement of the century, that 30 years is uncertain, but we'll have to wait 100 years to find out. 30 days seems pretty uncertain nowadays.
Fair enough.
What about, does the model ever result in a zero loss being appropriate, or do you have to record a credit loss of some sort?
Yeah, so all financial assets that are in scope of the standard need to be evaluated for a credit loss reserve. So they should be evaluated. But with that said, it is possible to arrive at a credit loss estimate of zero, though the guidance does strongly suggest that should be a somewhat unusual conclusion to reach. And so you shouldn't go out and just assume that, well, I'm going to collect my money, so my reserve is zero. It should be very rare that you come to that conclusion, though it can happen. So maybe a common or somewhat common situation where you might reach that conclusion is in the case of something like Treasury securities, where it's a very safe investment. It'd be reasonable, potentially, depending on the facts and circumstances, for a company to conclude that particular asset has a risk of loss of zero. And so that would be perhaps a reasonable conclusion to come to. But take, for example, collateralized assets. I think that's an area where sometimes companies think that they can come to that zero conclusion simply because the the current value of the collateral is greater than the financial asset that is collateralized. And so they might just say, well, I have this collateral that's worth $100,000 and my asset's only worth 75. So I don't need to record a credit loss because I have this collateral that's worth more. The guidance is very clear that the current value of the collateral cannot be used as the sole basis for concluding on your expected credit losses. So that's really important. The collateral is an important aspect of this, and it should be considered. But the current value of it in general, there's some exceptions, some very narrowly defined exceptions in the standard, but generally speaking, the current value of the collateral cannot be used as the sole basis. So you should also consider the nature of the collateral as well as kind of future changes that are expected in the value of that collateral. So collateral is important to consider, but it goes deeper than just the current value of that collateral.
Yeah, I'd probably just add a quick point to that as well. I think it's real important about the measurement of the credit loss is that, the standard's really specific that even if that risk of loss in that forecast period is remote, the standard still requires you to recognize a credit loss. So, it's a very, very low bar for having to record some type of expected credit loss on most of these financial assets. And that's even the case for corporate bonds that even maybe AAA rated, you think those are, highly rated financial instruments, but, even looking at corporate bond studies, you'll still see that there's even some small risk of loss across corporate bonds. And so even in something that's as highly rated as a AAA bond would not necessarily be, acceptable to have that zero loss kind of conclusion. So it's in very limited circumstances, as Robby was suggesting. All right, maybe we switch gears and bring Caroline back into the fold real quickly. So we've talked a lot about the accounting, how the models will work and kind of different ways you can apply the standard. But maybe we can switch and talk a little bit about how applying CECL will impact, companies' financial reporting, particularly on the balance sheet and the income statement. What does the application of CECL look like within the financial statements? What can preparers expect?
Yeah, so on the balance sheet, you'll present the in-scope financial asset at amortized cost, and then the allowance for credit losses will be presented separately as a contra asset. And you actually do this for each group of, financial assets or in-scope financial instruments that you're presenting. So, for example, if you have loans and leases, and you have one allowance for credit losses on those, that group, you present that. And then if you had a separate allowance for your trade receivables, for example, and you're evaluating those differently, you would have a separate, trade receivables line, separate contra asset for your allowance for trade receivables. And then on the income statement, you'd present your credit loss expense for that period.
So what about, obviously new standard, we talked a lot about assumptions and things that companies have to think through, especially evaluating risk and things of that nature of their financial asset portfolio. What do disclosures look like under the standard? Are we looking at more expanded disclosures, more limited? Kind of what's the direction that the FASB took with the issuance of this ASU?
So, the majority of the disclosures are consistent with what was required under legacy GAAP. So things like, what you would have previously disclosed for your allowance for doubtful accounts, if you have credit quality information, any PCD assets that you have, all of those things are consistent with legacy kind of disclosure requirements. The new piece that's required is that there is a roll forward for the allowance for the allowance for credit losses that's required now, and then really just a qualitative description of management's estimate. And this is really just consistent with most disclosures about management estimates. So what are the inputs? What was the methodology that management used? And then if the estimate changed, what factors led to that change? So just some qualitative disclosures around that, consistent with other standards that involve management estimates. So nothing too crazy.
Well, that's good to hear. And then how would a transition work? So an entity that's looking to adopt or implement CECL, we got, like we mentioned at the top of this, that private companies, they still have a little runway before they have to get this into their financials. But when it comes time for transition, how does that work in transitioning from kind of the old incurred loss model to applying CECL?
Yeah, so the transition method for most of the in-scope assets is a modified retrospective approach. So that'll be, cumulative effect adjustment to opening retained earnings in the period of adoption. There are a few in-scope debt securities, or PCD assets is another example where the prospective method is used, but I'd say the vast majority in these instances would be the modified retrospective approach.
Okay. And then again, for private entities, when is this effective? When do they need to worry about this for calendar year end?
Q1 2023.
Oh. So not right around the corner, but never hurts to get a jump on things here. So maybe just rounding out, here a few more questions just on the topic. For you guys that have been working with clients on CECL, what are some challenges that you saw, especially public companies went through this last year, implementing it obviously in the kind of wave of the pandemic with a million other things going on. So it was definitely a lot stacked up against most preparers and accountants trying to implement a new standard as well. What were some challenges you guys saw or heard about that we should keep in mind or kind of look out for as we get, private companies start to look towards adoption?
I'll go first. So I think just generally kind of consistent with any first year of adoption, just a question of, what's too much versus what's too little, and really just kind of keeping with the intent of the standard. So using this year as an example, issuers probably had some difficulty, especially if they had a calendar year end, how around December is when, the vaccines in the US two of them were authorized. So how much longer do you consider COVID as part of your reasonable and supportable forecast? How much do you disclose about how much that affected your forecast? So I think certainly this year was an interesting year for it to be, the first adoption year. So I would say that was probably a pretty difficult consideration, kind of a complicating factor in 2020 for sure.
Yeah, I guess what I'd add is that the challenges that are faced are very much, I think, dependent on the company and the financial assets that they hold. So I think oftentimes one of the challenges is kind of the new piece, right? Because a lot of times companies have already considered historical loss experience as part of, for example, the allowance for doubtful accounts. But the new piece is that reasonable and supportable forecast and the current conditions as well. So understanding what inputs to include in that forecast, setting up their processes to be able to support inclusion of those new inputs, putting new controls around those altered processes. I think that's where there's been challenge, especially when it's a non-banking client where they primarily have trade receivables as their exposure to the new standard. And so that's where I've seen kind of the challenges that they face simply because that's really what's changed for them. They're still able to, especially if they already had a robust aging process that they were using to evaluate their trade receivables. They're really just layering in those additional pieces and putting processes and controls around those. So another, I guess, one implication from I mentioned controls briefly there. One additional piece there is that even when these companies have used an aging schedule-based approach, oftentimes they're looking at all of their trade receivables that fall into these aging buckets, but there may be some additional requirements under CECL to kind of disaggregate those assets further because there's other risk characteristics that are relevant besides just the age of the financial asset or of that trade receivable. And so that may be another change in their process, right? And so that's another, just as an example of a challenge that a company's going to face as they're looking to implement the standard is how do they alter their existing process because they already have the process in place, but now they need to disaggregate further and look at the forecast, right? So those are the challenges that I've seen.
Yeah, no, I think that's a really good point. I think, oftentimes we always focus on the accounting and kind of forget about the internal control environment and making sure that processes and related controls have been kind of spruced up to address as well the changes in the standard. So, like you mentioned, obviously pooling's new, so additional processes around reviewing pooling of financial assets, and then you think about you're adding forecasting in here and probably review controls around those forecasts and things of that nature. So definitely good points to keep in mind for sure. I guess I'll kick it to Sarah maybe to close us out with one final question.
Yeah, to round us out with the question on everyone's mind, I'm sure. If the CECL standard were a movie, what movie would it be and why?
Do you want to go first, Caroline?
Sure. So I said Inception because, you can go down all these layers into the standard and get really complicated. But these people in Inception always have kind of a tell that lets them know whether they're kind of in reality or in a dream. So I would just, I think that's important for management companies who are considering this, especially private entities. Just have your tell whenever you're looking at CECL. And for me, usually the tell is kind of what was the intent, and are you in line with kind of the FASB's intent for the standard. So that was mine.
Okay. I like that. Also a great movie, by the way. One you can watch over and over, no doubt about it. I still don't know what happened, but I'm still trying to figure it out.
I would have said Inception because I still don't know what happened. I'm still trying to figure it out.
So when I was thinking about this, I was thinking it would have to be a movie that, one, you have no choice but to watch, right? We all got to do this CECL thing, right? So that'd be one. Requires you to plan in advance to get prepared. 3, something that has its ups and downs, maybe a little bit painful even to get through, just like implementing any new standard. But then at the end, if you plan correctly, do all these things, you're going to have a sort of a happy ending, triumphant end to the whole thing. And so that's kind of what I was thinking through as I thought about, what movie. So with that in mind, I said maybe Forrest Gump. And so hear me out. So Forrest Gump. So first said, you have no choice but to watch it. So Forrest Gump's a classic. It is a classic. It is a culturally important movie that everyone's got to watch. If you haven't seen it, it's been out for 25 years, so you should go watch it. Going in, the thing is going in, it's going to be a tearjerker, right? Especially if you've seen it before. And again, you should if you haven't, because been around a long time. So it's going to be a tearjerker. So, you got to make sure you have a plan. You got to come in with some tissues, maybe a blanket to hide your tears, because you're definitely going to cry in the movie. No doubt about that. As you go through the movie, there's so many ups and downs, right? Like he's, Forrest is a ping pong champion, and this is his great high. And then there's all these devastating things that happen. Again, if you haven't seen it, try not to spoil anything for you, but you should have seen it. But there's all these ups and downs, throughout the movie. But at the end, as you kind of get to the end, there is a sense in which you can kind of see that the bright future that exists, not for all the characters in the movie. So it's not perhaps a perfect fit, because Forrest Gump kind of has a little bit of a sad ending too. But CECL doesn't have to. If you're stepping through all of the things that we talked about, and some of the other things that should be considered, CECL can have a happy ending as well, as you go forward. And so I say Forrest Gump, not a perfect comparison, but also just another great movie. So. Yeah.
And just like Mama said, life is like a box of chocolates. You never know what you're going to get, so you better reserve for it.
That's right. Love it.
All right. Well, as always, there's so much more we could do to cover this topic, but we will put links to additional resources in the show notes so that our viewers and listeners who want to know more can go and find out some of that stuff. Thank you, Robby and Caroline. Adam, you as well, for joining and dropping all your knowledge bombs on us today. And thank you to everyone for tuning in. We hope you found this discussion helpful, and we look forward to having you join us again on another episode of Accounting Matters. Thanks.